rally from the lows of the 27th of January. And let's just hope that doesn't come into play, because then you're looking at that January low. So it's a small change, unchanged, more down than up. That's a Nifty heat map emerging into view as well. Some, I think, 30-odd names are lower and the rest are higher. But this is just the inside of the first 1 minute of market open that we are looking at right now. But stocks, Surabhi.
Yeah, I mean, right now the Midcap index, it fell 0.5%. Now it's trying to find some stability, down about 0.3, 0.4% thereabouts. Ircon, I mentioned, there's one more Gopal Snacks, by the way. Bhujia is not tasting very good this morning, just like what we saw with the other company, Bikaji. Anyway, on the Nifty, let's see, what's positive. IT is providing some support. TCS, Infosys. These are two stocks right on top. Tech Mahindra is actually, joining in to make a trio. There is some buying on HUL, ICICI Bank, Britannia, L&T. So there's some consumer buying overall. That's one trend we can spot. Tata Consumer, HUL, like I said, Britannia. There's some gains over here. And then a couple of the banks are trying to support. ICICI is one of them. Let's see what the others are doing. That it starts fizzling out after that. IndusInd is lower. Kotak Mahindra Bank is lower. Axis is also down 1.5%. So there's no real clarity in terms of the large bank moves right now. And HDFC also is, for the time being, it's on the red side of the screen. So very flat on the bank Nifty as well. In fact, talking of the losers, Hero Moto, M&M, there's Reliance, which is down about 1.2%. So Reliance is big heavyweight on the downside. Absolutely evenly spread out. No sense of clear direction on the Nifty, at least.
Well, that's right. Surabhi, and a few stocks that are calling for attention. Zaggle Prepaid, another day, another circuit down, but this time it's a 5% circuit down. ITC Hotels as well was showing some promise. A lot of delivery-based buying a few sessions ago. It went to 180. Now it's around 167, but that as well comes up as one of the top volume movers. United Breweries, yesterday Sudarshan had told us about the price hike that they're getting in Telangana, and some of those dues as well are being settled. So explains why United Breweries, well, that stock is one of the rare stocks in the green, up close to around 3%. Sale, difficult to call this one, and a lot of debate on the street whether or not, the numbers are good or bad. But at least as of the numbers that we had, volume growth was fairly okay. You had input costs that were a little bit low. You'll have to question why the employee cost was so much lower as well, and some debt reduction as well. So that underperformer that's seen a big correction from the recent peak, that's up close to around 3%. Nalco pulled back big time in yesterday's trading session. From the high of the day, it was down close to around 8%. Today, for starters, it's up close to around 2% or thereabouts. Antique was one of those brokerages that are fairly positive on the stock. And I think Berger Paints as well. Wow, good green out there. That's up close to around 3% as we speak. So some green on the screen. The breadth of the market is in favor of the number of stocks that are declining. But the sense you get just looking at the screen is some of these stocks, well, there is some buying interest that we're seeing, but let's see how the course of the day pans out.
Well, 2:1 declines to advances. So it's not that bad. It's not as bad. It's bad enough, but it's not as bad as the last 2 days, 2 or 3 days specifically. And the index is settling down 20 points. Just 2 or 3 more names. Gensol is down 12%. Usually it doesn't come up in the top volume-led list. But Gensol is down 12% on some volumes, not humongous, but some volumes. Kirloskar Oil Engines is down about 6%, and it's got large volumes, so 736 on Kirloskar Oil Engines. There is K Fintech, which is down about 4.5%, 990 on K Fintech. Again, it's had a bit of a swoon, absolute crack, and then a bit of a recovery, 100, 200 rupee recovery, and then now back under 1,000 rupees. And I think the others we've already mentioned, Zaggle, Ircon, Amber is down 3%. And of course, Time Technoplast is down a full 8%. Our research team highlighted that in the morning with the numbers and the rest of it.
Prashant, just one more trend to highlight, that PSU stocks, which have obviously taken brunt of the beating, there's some semblance of buying or recovery in PSU names like NMDC, SAIL, a couple of banks, Union Bank, Bank of India. So these are Bank of Baroda as well. Some green on the PSU side of the screen this morning. Vineet Samre is our next guest on the show. He's head of equities at DSP Mutual Fund. And of course, he's spent a long time in the market to see many such cycles play out. Vineet, great to have you on. Let's dive straight into this whole debate on mid-caps, because people are really wondering what to do. Those who are still holding on to profits are wondering whether I should sell now, sell at a bounce and protect my profit. Those who haven't dabbled in are wondering if this is a great time to start buying mid-caps. What would your advice be on the broader market?
So, see, I think we have seen in the past as well that the small and mid caps in general, when we look at the market falls, the small and mid cap tends to underperform the large caps by almost a margin of 1.5 to 2x. So if the large caps are, let's say, correcting down by 10%, small and mid cap will have a higher burden to sort of bear, because anyways when the bull market is there, people are exuberant, they try to take the valuation significantly higher on the small and mid cap, and we see a lot of bad behaviors also in terms of the quality of stocks. So I think it is natural that when things correct, this is going to correct down slightly more than what the large cap does. But also in the past, our analysis suggests that in these kind of markets where some kind of panic sets in, I'm not calling a full-blown panic out here, but some kind of panic which has led to this fall, it is always good to start with an SIP, because what will happen is that in the course of this correction, one will keep averaging out and accumulating the NAVs at a lower point. Because one important aspect which has to be kept in mind is that for us the ultimate objective is to capture the India's growing growth, being a growing economy. And as far as small and mid caps are concerned, I think the companies have also emerged stronger. They have become leaders. This whole consolidation has led to many companies becoming very capital efficient also in the process. So I think if we keep following that discipline over the course of the period, the investors will definitely see fruits. But I think at the moment, the narratives have changed totally. We have, from a virtuous cycle, we've gone into a vicious cycle.
Yeah.
Some more pain, but I think that's how one should sort of think.
Okay, of course, you have to be reasonable and keep the medium to long term in mind. Vineet, what have you been doing in this fall? I mean, even to your, different schemes like Flexi Cap or the other schemes, have you been adding on the mid-cap, large and mid-cap side of the, funds? Have you been in the market buying more of mid-caps and small caps, or as a house, is the preference towards large caps now for you?
So I think in general, across the categories during this period of market corrections, we're trying to see that can we make some switches and rebalance the portfolio. Given that we are calling out for the next growth trigger being, let's say, consumption, given how the government has been trying to showcase that in the budget, and investments sort of has taken a backseat. So I think not sort of taking a big call around the asset allocation from the large cap, mid cap perspective, but more from rebalancing from the sectoral perspective is what we're trying to sort of look at.
Got that. Good to speak with you, Vineet, and good morning. It's the old argument that you just ride up and down, and long periods of history do tell us that that's the way to go. They don't try and, sell or create cash too much. I mean, by the way, did you guys do that? Because I was having this interesting chat with an old veteran money manager who manages his own money now. He was saying, well, sometimes excesses are so stark that as an institution, it's tough to do, but as an individual, maybe, things just don't make sense, and you create cash, because only then will you be able to buy at the lows, because what comes after lows are better tidings. But if you're fully invested, then you just sort of play it out, ride it out. And I suspect many find themselves in that situation. Just wanted your thoughts there, Vineet.
So Prashant, in general, we have always remained largely invested, but especially in case of small and mid caps, we have been on an average between 4 to 6% kind of cash levels we've kept. That is in general practice, because anytime, during even bull market, there are cases where stocks fall, and we would want to keep that as an opportunity, and also from the liquidity perspective. So cash has a slightly different sort of a strategic thought process out here. But from the investment perspective, we do not want to take cash as a strategic call, because if you look at the last 20 years, the small cap, let's say, index has delivered between 13-14% return. If someone would have had 6-7% cash, that is a drag on the overall return over a long period of time. So when investor is actually giving the capital to us to invest, I think we principally think that we have to keep remaining invested broadly, and cash is more from the liquidity, and as you mentioned, bit of this opportunistic type of strategy is what we sort of go by.
And we get the MF numbers today, Vineet. Flows have remained absolutely steady.
Yes. So I checked the number that till yesterday. I think broadly the flows are trending on an average the same levels what we were. But I think so. I think, Prashant, this is very interesting because the behavior is going to, let's say, lead to, if we are calling this, pendulum swinging on the other side, that's going to be the investors' behavior. And I think till now it is all good, but we don't know last 3 years, as we keep saying that new investors have joined, and their ability to sustain or stomach this volatility will watch over the course of next 1 or 2 months. But this will be interesting from the market's volatility perspective as well.
We had Atul Mehra with us, and he was saying $55 billion worth of insider selling this year. 55 billion. And I asked him whether supply will perhaps overwhelm demand. He said, well, that depends on SIPs and retail flows, which you are saying so far is steady. But it's
So
that 55.
some bit of SIPs have incrementally slightly increase in the redemption or stoppage of SIP, but I think broadly we shouldn't be worried as of now.
Okay, all right. Hi, Vineet. I recall towards the end of last year, you said you're not expecting the markets to dance away to new highs. And as of now, the market is worried. How low can we go? Do you think bulk of this, pullback that we have seen on the Nifty, it's 10% thereabouts, the mid and small caps, indices are down close to 18 to 20%. But individual stocks have seen a bigger correction. So how much more pain do you believe is in store?
Yeah, Nigel, I think you're right. Let's say if we just go by the arithmetics, today we are at 19 times on Nifty, let's say broadly, and we've corrected by around 12-13% from the top. We assume that, let's say 17, 18 times is the base kind of valuation for the Nifty. Then we have another maybe 8, 10 odd percent. But I don't think, that's a big number because the broader market will see even, more impact. But I would say that a correction is there. Maybe if we get new triggers in terms of, let's say, consumption starting to show up, or there is some visibility on the earth, which today is not there.
Vineet just missed that number. 8 to 10% is?
So what I'm saying is that today we are at 19 times.
19 times, yeah.
And assume that if we go down to 18 times, and there is 1,000 point more to be given up from the Nifty's perspective, which is let's say 5-6% kind of a number. And 17 times, I think it is difficult, but markets one can't predict. But I think that is what one should go by. And like you said, Nigel, more importantly, if you look at the broader markets, we have seen more than 50% of the stocks actually correcting by more than 30-35%. While they are not cheap, but I would say that a large part of the correction has sort of taken place in the broader market. At some point, it should consolidate, is what I feel.
Okay, so Vineet, what you're saying is that maybe another 5 to 6% of a downside on the Nifty could be possible, but the bulk of the mid-cap pain perhaps has already played out. So that brings me to the interesting question. What are you buying? You mentioned consumption, that in the rebalancing you've added some consumer names. So if you could be a little more specific in terms of, is it discretionary, is it the hotels, travel, those kind of names, is it jewelers? And beyond consumption, what else? What else have you sold off a little, book profits in the rebalancing? And what would you be comfortable now gradually buying?
Yeah, so see, industrials, because of the change in the, capex targets, we have been and the expectations are high, the valuations are high. And hence we have been sort of lightening up on the engineering part. And, some part of that is getting into consumer durables, let's say, more discretionary, because we feel the benefits which will flow in because of the tax benefit should you should give some kind of impetus to the consumer discretionary. And on the other hand, I think some of the segments are non-linked to any of these aspects, just like, hospitals, they have been delivering good results. Insurance sector has already seen the pain, and a large part of the regulatory changes, be it surrender charges and all those. After bearing all that, I think insurance businesses are stable. Stocks are down. So I think those are the segments which one can sort of focus on. And incrementally, I would say, and I keep saying this, banks are cheap, but they are also going through a bit of this transition, NIM resetting, asset quality. I would, we are watching that space maybe 1 or 2 quarters, and that space would also start looking interesting, which is a big space to own sort of.
Okay. If you own hospitals in your portfolio, Vineet, you may want to listen into the next conversation, because we have the management of Medanta joining us. Thank you very much for joining us with that perspective, Vineet, and speak to you soon again here on the channel. Let's talk about Medanta's third quarter performance. Their margins improved sequentially While occupancy levels were also stable, companies seen healthy volume traction for mature and developing hospitals. Let's talk about this in some detail on the third quarter and more importantly, the outlook. Naresh Trehan is Chairman and Managing Director at Medanta. Pankaj Sahni is Group CEO at the company. Gentlemen, great to have both of you here. Appreciate it very much. Dr. Trehan, good to see you. I think you're coming back on the air after a while out of your busy schedule. Just a quick word.
Thank you. Thank you for having us, and good morning to everybody.
Morning, sir. Prashant here. So, average revenue per occupied bed, sir, was a bit muted in the third quarter. And what some analysts are pointing out, that is because the average length of stay was slightly longer. So, for patients under schemes. Could you tell us, could you give us some perspective on that, Dr. Trehan? What's, how should we read this?
I'll hand over that question to Mr. Pankaj Sahni, who will walk you through the numbers.
Okay.
Yeah. Right.
Thank you, Prashant. Actually, if you look at our performance, you see that our average revenue per occupied bed, when you look at it on an annualized basis, is up about 1%. Our length of stay is down about 3.2%. When you look at things on a sequential basis, obviously there is some impact of seasonality. Q2 having some impacts of some of the seasonal diseases like dengue, etc. So may not be extremely appropriate just to look at a single metric like RPOP. When you take just a quarter-on-quarter basis in a business like ours in healthcare, you have to look at a slightly longer period of time. I think more important than RPOP, though, is the real number is the realizations which the patients pay, what we call as the average revenue per patient, so ARPP. And that gives a slightly more reflective point of view on how things are moving. Now, we in Medanta have been very cautious and conservative on tariff increases. So if you look at our hospital in Lucknow, it's a 5-year-old hospital now. We haven't taken a tariff increase in complete 5 years. Our hospital in Patna will be coming up to 3 years. We haven't taken a tariff increase in 3 years. And these are actually by design. And the focus of Medanta has always been to try to ensure that we focus in on volumes. You look at our volume growth on inpatients, it's up about 10% year on year for the last several years consistently. And that focus has been to try to touch more and more people and provide healthcare to more and more people rather than trying to extract the maximum amount of income from a smaller group of people. Our focus has been serve as many people as possible. So we don't worry too much about RPOP. When we look at it on overall volumes, overall revenues, overall profitability. And we're doing very well across all those dimensions, both in mature and developing hospitals.
Dr. Trehan, give us an overall sort of overview in that sense across the hospital in NCR, Lucknow. What's the trajectory? What should investors and viewers expect as far as trajectory for the chain is concerned?
So there are two facts that should be known. One is Medanta represents the highest end of care that anybody can deliver. And we want to maintain that space forever. Because our DNA is to give the highest end of care at affordable cost to the maximum number of people with integrity. Now, keeping that view in mind, we have taken very solid steps forward in developing the company. And the latest one will be Noida, which is a close to 600-bed facility, which is going to come online in the next 3 months, 4 months. This will cover Noida, Gurgaon, and we have announced 2 projects in Delhi. One in South Delhi, which is a 400-bed hospital, and the other one is in North Delhi, that is Pritampura. It's going to be a 700-bed hospital. So that's the growth that you are expecting immediately. And we have many other projects under development, which we shall be announcing as we move forward. So there is a expansion going on in a very solid state, step by step. We are looking at many opportunities. We have so far done greenfields because we want to maintain that standard which is required to give the highest end of care. So it's not only the facility, it's not only the technology, but it's the human capital of that superior variety to match these two so that you can actually have a system which can consistently deliver with the best results and the best quality of care that you can give, even procedures which are difficult to handle in other places. So that's been our move always. We are growing. If you look at it, by the end of, you have also heard about our announcing the 700-bed hospital in Mumbai. So that will take our strength from 3,000 plus today to close to 5,000 plus in the next 3 years. So that's the prediction, and we are giving the other thing that we have, if you look at our geography, which we have covered, is providing the care which was absent from those places. So Lucknow, Patna, Mumbai where we are is actually very underserved. And especially the quality and the complexity of the procedures that we do are not present there right now. So that's why we are always looking at where to serve the people, maximum number of people, with what I already said about the quality and the integrity and all that, so that we become the trusted brand in healthcare. So people know when they come to us that they will get the best. So with that in mind, we are doing very deliberate expansion, and there are plans in many other cities, but we are not ready to announce them yet because we want to get the whole base established before we bring it to the market.
Okay,
So that's been our plan.
No, that's very good.
No, I think that's
That was very good detail. So 3,000 beds will go to 5,000 beds in the next 3 years, right? And that's a broad kind of, in terms of announced projects. And you're saying there are more, there's more which you will do, which you will announce as time goes by. Pankaj, if you can tell us this addition, how much is all of it for now, what you've announced is greenfield?
No. So the way in which we build out our hospitals is we put a bunch of the infrastructure and the capex up on day one. So if you look at our Lucknow hospital, it's currently operating at about 750 beds. That will go to about 1,000 beds. So about 200, 250 beds will come there in the existing infrastructure. So really true, genuine brownfield. Just the interiors need to be done, and we are actually already underway in construction in finishing out some of the floors there. So 200 plus beds will come in Lucknow. If you look at our Patna hospital, it has a capacity of 650 beds. We're currently operating there about 430 beds. So another 200 beds will come there. That construction is also already underway. So that also is your true brownfield. Dr. Trehan mentioned our hospital in Noida. That's a 550-bed hospital. That hospital is almost complete. We hope to open that within the next couple of months, sometime maybe towards the middle of this calendar year. So that's also, you can say, although it's a greenfield project, it's almost near conclusion. And then the 3 hospitals that Dr. Trehan announced in South Delhi, in North Delhi, as well as in Mumbai, these are greenfield hospitals, and that will take us a couple of years to build out because those are going to be build outs from scratch. In addition to that, as Dr. Trehan mentioned, there are a couple of sticks in the fire that we are hoping to be able to conclude on as we move forward. So, the important thing to understand with when Medanta makes a move, it's really clear that we want to make it in a very definitive and deliberate manner. We want to be able to do it so that we can deliver very high-end quality of care. We're not chasing an absolute number of beds just because, it sounds like a good number to have. It has to be able to be in sync with our philosophy for providing high-end care, going to the places which need quality care the most, and being able to create an ecosystem that delivers that care in terms of infrastructure, technology, and of course, most importantly, the clinical talent. So that's how we're moving. We've also signed up a new agreement, which was announced in our Q3 results in Ranchi. So we're adding about 150 beds in Ranchi. That would be right near the existing hospital campus. So that should take our Ranchi facility from about 200 to about 350 beds or so. That hospital we should operationalize within the next 2-3 months.
Sure.
So a lot of action happening on that front. And also, like Dr. Trehan said, exploring cities where we are not yet present, but where the need is there for the kind of standard of care.
Right. All right, gentlemen, thank you very much for joining in, and good luck with those plans. Appreciate you taking out the time and being with us on the show this morning. By the way, look at the screen again. Sorry to report, but this is the reality. So early on in the morning, this is 3rd day running now. Midcap index is down 2%. Advanced decline ratio has completely gone out of whack once again. You've got over 2,000 stocks advancing. And now, so far, it's like 2.5 trading sessions because we're not even halfway through this one. The mid-cap index has lost 7%. The small-cap index has lost 7.5%. So the Spain, while, of course, we're hoping that it kind of starts easing up, doesn't look like it. And even the large cap screen right now is fairly weak, 0.7% lower on the Nifty and the Bank Nifty. So let's see. We'll get to some of the specific stocks in action in just a bit. But right now, another quick corporate conversation. Cholamandalam Investments is on our radar. Third quarter performance were more or less in line with the numbers. Disbursals were very, very healthy. AUM growth was also quite healthy. But is there a bit of a hiccup on the asset quality? What are the trends going forward? Well, let's discuss this with Mr. Arun Selvan, who's the president and CFO of Cholamandalam Investments. Sir, thank you very much for joining in. And I was looking at the numbers. It's absolutely phenomenal, right? The kind of AUM growth that you've had, you're growing in your 30s, and that growth is coming across all parts of the book. The vehicle segment is up about 22%, LAP and SME 39%, home loans are growing at 42%. So it's all very good. But the question is that do you have any concerns around some asset quality issues? There's a slight increase in gross NPA. Credit cost, I think, is at 1.4. And your provisioning is much, much higher. Year on year, provisions are up, I think, over 90%. What are you expecting on asset quality?
The asset quality is, is little bit of under, higher levels in vehicle finance and also in the consumer and small enterprise loans, which is unsecured segment where you are seeing some amount of asset quality. Part of this is mitigated by the FLDG, which is coming in the income line of the CSL, but it's not a large number. Yes, overall, there has been a bit of a higher levels of stress in both vehicle finance and the CSL. The other aspect that you need to factor in is in both the LAP and HL, last year we had reversals of NCL primarily arising because of the accumulated NPAs during COVID getting resolved through the SARFAESI action, thereby giving us a negative NCL, which is now coming back to normalcy. And so year over year, you may seem that it has been an increase in these two segments. Otherwise, these two segments are actually doing very well. So
what is, sir? Overall, so if I could just, if I could just complete that. So you're saying the stress that you've noticed is in vehicle finance, and you mentioned some parts of unsecured. What is the total quantum of your unsecured book, and how much is it as a percentage of the total book?
It is 8%, and even in this, it is not all of this 8% is under stress, as you would, we have discussed this earlier. 3/4 of the 8% is under traditional route, which is where we do our own disbursements with our own teams and, not through the fintechs, which is performing reasonably good. The fintech business is where we have seen some stress and which is where we have been progressively scaling down. We have moved it from what we used to do with around 10 fintechs to currently around 3 fintechs. And progressively we'll take a call about continuing with them if the stress levels continue. In the meanwhile, we have built our own app and where this the fintech the same approach we have done with our own D2C business, and that book is performing extremely good. And so we expect to build on that book while we progressively scale down on the fintech exposures.
Okay, so given what you've said, that slight stress in vehicle finance and maybe some parts of the unsecured book, on the credit cost front, sir, do we see it rising? I think the credit cost is at 1.4% in Q3. What can you guide? And also gross NPAs, which have now touched 4%. Is this the peak, or could it increase a little bit before it stabilizes?
No, in Q4, it will come down. I mean, this is always the traditional, way it happens. So Q4 NCL and NPAs will come down across all segments, and you will see a reduction. The overall full year NCL should be in the range of around 1.3%. So it will be a reduction compared to what you're seeing by TT December. But it will again move up a little bit in Q1, Q2, but then next year we expect things to be back to normalcy. The NPA number you said is the RBI number. The stage 3 numbers are lower, so that would be at the sub 3%.
Okay. So you're saying that Q4 is better, then again maybe Q1, Q2 see a little bit of a pickup in stress, and then it stabilizes in the second half of the new fiscal. Got that point. So let's talk about then the cost of funds as well and margins. We are in the midst of the beginning of a rate cut cycle. 25 basis points has happened. Of course, the Reserve Bank didn't do anything to lower the risk weights for loans being given to NBFCs. Just how are you evaluating the liquidity environment and the cost of money for you?
See, for Chola, liquidity has never been under any issue. So we are getting money thanks to our reputation and the bank support. So we are having a good amount of liquidity in pipeline also, and so we don't see any stress on the liquidity side. On the cost side, around 16% of the book is linked to T-bill, and another 8 to 10% is linked to repo. So these 25 to 30% of the borrowings will see immediate impact on account of the repo rate cut. Another 16% is linked to MCLR, where the banks may reduce, but it will take some time, is my view. So they will not reduce. On the fixed rate, yes, the balance is on fixed rate, around 60% of the book, 55 to 60% of the book is fixed rate. There you will not see immediate reduction, but as they come up for, repayments and renewals, you will see the reduction coming. Overall NIM
overall NIMs, all of this put together, the external benchmark link part of the book, and there's MCLR link, which obviously doesn't move, fixed, floating, all of it put together. What's the outlook on margins?
Margins should hold is what I would conservatively say right now, rather than build up too much hope. These are, little volatile days, so we'll wait for things to pan out. I think Q4 we should hold the margins, and then we will see reductions in the cost of funds coming up in Q1 and Q2, thereby improving the margins.
Mr. Selvan, good morning. Prashanti, I just had a broader question. I mean, you guide very minutely on across parameters, but and I've asked you this before, last 1.5 years, the regulatory whip of the RBI was, it came down hard across the financial sector. And not just that, but in other areas as well. We're seeing a bit of a change under the new dispensation of the Reserve Bank. There's more liquidity, etc. as well, which you alluded to. Will generally things get a little better for the financial, for your industry, for NBFCs? And of course, we've asked that question to banks as well, and the answer has broadly been in the affirmative. Just wanted your sense, sir.
See, I think, I would answer it that if you are doing things right, you will never be in trouble, irrespective of who is at the helm of the regulator, whichever regulator we are talking about. So it's better you keep yourself clean and simple. Don't do complicated things. Then you will have lesser problems. I would rather say it's instead of saying this regulator versus this period versus that period.
Okay. No, that's a broader. That's good life advice as well. But so you're nicely. But that's
I think
good.
Politically correct answer.
Okay, no, I get that. I get that. But okay, not okay. Forget the regulatory side of it, right? But more liquidity in different, because it's all interconnected, right? More liquidity, easier conditions for consumers. I mean, it does help your borrower as well. Actually, everyone's borrowers, a little bit of the margin.
Yeah, see, the key is that the capex spend and government spend increase, both in through capex as well as in the rural developments, that would put money in the hands of the consumer, which would in turn spur demand, which is where we will get to have traction with our vehicles, with our borrowings, etc. So the crop has been good, and the projection for the monsoon for the coming year is also reasonably, comfortable. So everything looks very good. The global environment is a little tight with so much of variance, differences that is coming up. But I think we are a little bit insulated from the global influence, but we cannot be completely delinked. So we will have some impact if things go worse. Otherwise, outlook for FY26 seems to be a good, period that is coming up.
So what's that outlook in a numerical sense, sir? FY26, since you touched upon it, what's the kind of growth of the book that you'll target?
We keep our target same level, ma'am, at around 20 to 25% is what I would right now talk about on the AUM growth. And we will certainly see profits also at reflecting this growth as we move forward into the coming year. We'll endeavor to do better, but I think at this juncture, let us keep it at these levels.
Fair enough. We'll work with that, sir. 20 to 25% AUM growth in FY26, and then let's see. Once the impact of the rate cuts kicks in, maybe you're saying that margins will also improve, perhaps third quarter onwards. Got it, sir. Thank you very much for giving us that perspective. That's the latest from Cholamandalam Investments. Take a break. Once again, just revising the screen for the benefit of our viewers. 1100 down on the Midcap index. It's still painful. Nifty is down 1% now. 200 points lower on the Nifty as well. Contrast that with the Hang Seng screen. It hurts even more because the Hong Kong Hang Seng is surging 2%. That's the kind of market that we're in the midst of. Let's take a break, come back on the other side, and we'll be in conversation with the management of Birlasoft. Talk about their third quarter performance.
Welcome back. Well, you're seeing very, very aggressive selling in today's trading session. It appears, someone's just taken this call, or quite a few people have taken this call just to sell on the screen. And that's what it looks like, because the Nifty is now down 210 points. The real pain in the broader markets, only 220 stocks are advancing. Yesterday, we end with an advance of close to around 230 stocks. A lot of stocks are moving around, so let's focus on that. Vinny is here to tell us about IRCON International. Vinny?
Absolutely. So IRCON International is clearly under pressure today. Almost we're seeing a sharp decline coming in for the stock because of the weak numbers that they reported in Q3. Revenues declined by around 11%. Margins seeing a very sharp contraction of around 300 basis points, or around more than that. 5% versus 8.83% was the margin last year. Profits also seeing a very sharp fall, coming in just 86 crores versus 244 crores. 65% decline in terms of the margin profits of the company. Order book, yes, standing at 21,939 crores, of which 78% of the order book is railways, 22% is highways. But the impact on margins is one because of the lower top line growth that we're seeing. Material costs, that has seen a sharp uptake, more than doubling, and other expenses, that has also gone up very sharply. So overall, we're seeing the impact of all this coming in on the operational performance as well as the profitability of the company. And there's an increase in terms of work in progress versus last year there was a decrease. So that also is a factor that one should keep an eye out on. Weak set of numbers from IRCON is what we're watching out for.
Okay, all right. Thanks for that, Vinny. The other one that's getting slammed is Kirloskar Oil. Subdued set of numbers, Vamakshi?
Absolutely, Nigel. When you look at the numbers for Kirloskar Oil Engines, it's a weak set coming in. Revenue saw a muted growth of nearly 3%, but it's an 8% miss as compared to street expectations. The gross profit margin has expanded by nearly 77 basis points, but this expansion is being offset by a nearly 16% rise in other expenses, which is why the EBITDA margin has gotten impacted for the company. EBITDA margin has seen a contraction of 165 basis points year on year. This is 180 basis points lower than consensus estimates. When we look at the net profit, that too is seeing a fall of almost 21%, coming in sharply below what the street was expecting. The management has said that it was a subdued quarter with multiple headwinds. When we talk about their B2B segment, that saw an uptick of 3%, while the B2C segment declined by nearly 14%. The management says on the B2B side, as expected, there was muted demand in the power gen business post the emissions norm transition. On the B2C side, however, they say they successfully completed consolidation of 5 plants into one, which saw some impact on production. On the other hand, they say demand from infra and construction stays quite strong after successfully transitioning to BS4 on the industrial business, but they are watchful for trends in the power gen market. They're expecting demand will return to earlier levels in the next couple of quarters. But overall, when you look at the numbers, it's a miss as compared to consensus estimates, and resultantly, the stock is taking a hard knock in trade today.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's focus on another company, Birlasoft. The past quarter's numbers were weak. The stock has started off with a cut of around 5-6% odd. However, that dip has got bought into. So currently, in fact, the stock is down 1.5% to around 2% in this sort of a market. To understand about the way ahead, we're joined by Anjan Guha, the Chief Executive Officer at Birlasoft. Hi, Mr. Guha. Good morning, and thanks a lot for joining in. Well, Q3 was a weakish set of numbers. You have guided for some more pain in Q4, as furloughs are likely to hurt. So just my question to you is, no other company has spoken about these extended furloughs. So why particularly for Birlasoft, point number one? And for the 9 months as well, the revenue growth is very, very measly at around 2%. So FY25 is likely to be a washout. What about FY26? What kind of a growth number can you get back to?
So Nigel, first of all, thank you for having me on the show. See, we faced some furloughs in Q3, which we had not faced earlier, and it is outside of BFSI. So from that standpoint, from our perspective also, it was a little unheard of, and it came in the life sciences vertical. So we see the furloughs extending to the month of January, and it is specific to some of the clients that we serve. You must remember, Nigel, our life sciences business is more of a med devices business. And some of the med devices companies are facing some headwinds in the US. So we are seeing the furloughs extending a little bit. But by January, the furloughs will be done. I think February, March will be better months from a revenue standpoint. So from that standpoint, I feel Q4 will be also slightly muted. Now, for the year you spoke about, you're absolutely right. FY24 was a terrific year for us. FY25 is being a muted year for us, not only from a revenue perspective, but even from a margin standpoint. It's a little too early to guide for FY26. And like I was saying in the investor call yesterday, that I would want 4Q to first get over, and then we will give a view as far as FY26 is concerned.
Okay, all right. So some uncertainty, but Q4 will be a soft one. And at least you've given a heads up to the street, so the street is not bracing for any kind of shocker. Let's talk about profitability then. I recall in the past you've said that ideally you would like to go to mid-teens margins. For the time being, you're hovering around that 12.5% or thereabouts, give and take the wage hikes that come about. Do you see an improvement in margins starting Q4? And by when do you get to this 15% margin? What's the target?
So Nigel, look, we don't give specific guidance, but one of the reasons why our margins were down this year is because, like you rightly pointed out, our revenues have not grown. Ideally, if I could have delivered double-digit revenue growth, our margins would have held. And now we're continuing to invest in our business. Even if you look at Q3, we gave our wage hikes. It was a quarter where we saw tremendous amount of furloughs, but we were able to hold our margins in Q3 vis-a-vis Q2. So from that perspective, operationally, I think we have done better. Look, our endeavor will be to now to kind of operationally drive quarter on quarter to build up the margins going forward. We've continued to state that we will be more comfortable in that 15 to 16% range. It may take me 4 quarters to get there, but as we exit FY26 maybe, which is 4-5 quarters from now, hopefully we will get to the 15% range.
Okay, all right. So by the end of FY26, the street will take that. Let's talk about the net new deal wins. That as well, I think, is at an all-time low. It was only around $64 million. What caused that? And will that number improve in the coming quarters?
So Nigel, look, I mean, if you look at our first half year, the signings were not very good. But the quarter that just went by, Q3, we delivered record signings. I mean, at least in the past 3 or 4 quarters, this has been the best quarter in terms of signings. Now, I admit that almost 70% were renewals, but 30% were new deals. Q4, we are working on a couple of deals. If those deals come through, and those will also be in new logos, I'm expecting the Q4 signings to be as good as Q3 or even better. And if we can crack those 2 or 3 deals, then we'll be in a different position as far as Q4 is concerned.
Okay, Mr. Guha, business seems to be, have various points, and give us a fair idea about how you see the revenues, the new deal wins, the profitability as well. The other point is, I think your current market capitalization is roughly around 13,500 crores or thereabouts. And you have, 15 to 20% available in cash. I think your cash in books is around 2,000 crores ballpark?
Yeah, roughly, yes.
All right. In this time of uncertainty, will you all be thinking about rewarding your shareholders, maybe do a buyback, maybe give a one-time dividend? The stock, I recall, had gone to 850 or thereabouts. It's come back down to around 500 rupees. So what's the idea with regard to utilization of cash? Will it be to reward shareholders, or do you all have some inorganic growth on your minds?
So, Nigel, look, we always look at inorganic opportunities from time to time. Clearly, we've done a good job on executing and cash flow generation, right? Our operating cash flow to EBITDA, as you would see, is almost about 155%, which has been one of the best in the industry. So from that perspective, we are very happy that we've been able to generate cash. Now, I want to deliver 2, 3, 4 quarters of organic growth, before we look at an acquisition. Because I don't want the management to get distracted to go and do an inorganic buy when we really have to deliver, at least 3 or 4 quarters of organic growth. So we'll be focused on that. As far as dividend payout is concerned, our CFO has clearly outlined our policy. We will stick to that policy. And we keep rewarding shareholders with dividend payouts every year. So we will continue with that, Nigel.
And buyback?
That's a corporate action that is for the board to decide, not for me to say. We will see as it comes.
Okay, all right, Mr. Guha. We appreciate you joining in. It was a soft quarter 3. Quarter 4 as well is likely to be a little bit weakish, but you're optimistic about prospects of FY26, and maybe towards the end of it, those mid-teen margins is the direction that you'd like to head. Thanks a lot for joining in. Well, by the way, while we were having that chat with Mr. Guha, the markets have drifted down lower. We've almost moved to the 22,800 odd mark, which is the key reference point because that's the low that we saw in late January. 22,787, that was the recent low. We're not too far away from those levels, but that's only about the headline index. The problem is with the broader markets. Now we have seen a further correction, and I think 3 days on the trot, when you see the Midcap index pull back by 2.5%, and we're just an hour into the trading session, that's the pain point. You have only around 180 stocks now that are advancing from the Nifty pack itself. So difficult times, it appears so.
No, absolutely. And, the small cap index is basically broken down below with a 3% cut. The small cap index, if we can put that up, it's broken down below the January lows. The January low was 15,684. We are at 15,570 now. So while the Nifty is about 20-30 points away from that 986, 786 kind of level, 22,800 level. 786 was the absolute lows. So we're at 833. The small cap index is broken down below the low. And let me just look at the mid cap index as well. Here also we closed at the low, January low yesterday, and we've in a clean way cut through that. So 2.5% lower on the mid cap index as well. 10:1 is the declines to advances ratio. So it's happening very, very fast. And I suspect there will be margin calls, etc. as well, which perhaps are playing out, at least and that typically happens after a fall like yesterday, should kind of sort of work through the system by about 11:30, 12 or so. It's a fair bit of pressure across the board. What we'll actually also try and do is get, some of the CEOs of broking companies, for example, HDFC Securities, ICICI, and others, because what's the margining on the margining side? How are things looking? The MTF book, which is margin traded funded book, had grown exponentially over the last couple of years. That is essentially a levered product, and it's a funded product. So I'm assuming there would be pressure, and that essentially those are products typically where this kind of margin pressure and margin related squaring off would be happening. But 250 points, and we are basically back at January lows once again very, very quickly. We'll take a quick commercial break here. Mitesh will be with us with some a quick view on the market and any trades whatsoever. Stay tuned.
Welcome back. Again, a trying morning for midcaps. It's a relentless slide. The index is just slipping as if, there's a complete buyer's strike out there. 2.7% down on the index. It's fallen 7.5% now in just, 3 trading sessions. And this is not even the third full trading session. It's just the morning. Let's see at what point any kind of a recovery kicks in. We've got Mitesh back with us. Mitesh, you asked for the level and the level is here. 22,800. When you could have asked for anything, right? Maybe diamonds or whatever, lithium or whatever is rare earths. But anyway, your level is here. Is this the time to go long?
No, sorry, I think not yet. See, because you have hit the level. There's no sign of a reversal yet happening on the chart. So that is a very key part. Unless until you see that there is some evidence of trend turning on the upside. I mean, now I feel more that I've missed the short opportunity because 2 days back we were still in the long positions. But then again, I think while the level is there, if people are short, I think this is a good level to take profits, reduce your position, tighten your stop losses. Let's see if there's a reversal sign happens. Then I think we'll go long. Otherwise, just wait it out. And therefore, I think on the index, the only advice is that if you have been carrying some short position, if you have been the right side of the markets, take some profits.
Yeah. Okay, so if you've been lucky enough to short the peak, then time to book some profits. Otherwise, just sit tight on the index, do nothing right now. What about stocks, Mitesh?
Yeah. So I have a sell on ONGC with a stop at about 240 for a target of 235. And Manappuram Finance is a good loser today. That's a sell with a stop at 191 for targets of 175.
Okay, so those are some individual trades. Maybe I can just look at a few other stocks here, which are correcting. Look at Amber. So Amber is completely, low was 5,700 or so, 5,800 back in December, recent low from where it rallied very hard. It's almost back at those levels. Amber. K Fintech is down about 8%. This entire move from late January, basically from $1,000 to about $1,250. It's back at $950 now. So that's what's happening. Samman Capital, I think that's very large volume. This is erstwhile Indiabulls Housing Finance. Is the 4th largest volume-led loser, 10% lower on Samman Capital. And these defense names, Bharat Dynamics is, we should put that up. And I think HAL as well. There was and we'll try and reach out to HAL. There's a story, I saw a Hindustan Times story, some comments made by the Air Force Chief about HAL, which I think is seeming to be spooking the name here. That is also around about 4.5, but lesser than many other stocks that are selling off. So that's that. Tata Investment Corporation is down about 7-8%. Bayer Crop is down 7%. Kirloskar Engines is down about 11%. And so much more, which is coming off hard. So it's 10:1. It's a completely one-way market. And 10:1 in favor of declines. Vabag is up 2.5. That's a minor sort of reprieve here. UBL, the beer company, 2% higher. And something like a Schneider is up about 3% or so as well. That's it. Otherwise, they're very small changes. I mean, 1/3%, 0.5% in that range. If you want to look at what's holding out. And what's holding out is what's not falling, let me put it that way, is Infi, TCS. Some of these tech companies and pharma, Sun Pharma, etc. But they're 0.25% changes. So they're not in the red. That's it. Otherwise, 200 points lower, 22,858 is where we find ourselves at. Well, day 2 of India Energy Week is underway in New Delhi with 120 nations participating in the 4-day event. My colleague Manisha is standing by with highlights so far. Manisha, over to you.
Well, it's day 2 at India Energy Week, and we are looking at a lot of enthusiasm continuing here. And in the last 24 hours, there have been a lot of conversations, one especially on the crude oil availability. With all these sanctions and restrictions and geopolitical tensions, one thing is clear, that there is no shortage of crude oil because there are more and more countries now producing more, especially with the US going on the drill baby drill phenomena. You are going to perhaps be looking at much higher crude production. For India, the sources have now increased to 39 countries from where we take crude, and this is what Minister Puri has been constantly telling us, that there is no shortage, there is availability. Affordability is something that they seem to be working at this point in time. Also, India's oil and gas mix now seems to be improving much better than where we were 5 years ago, and that is a plus that various global ministers and global CEOs now seem to be talking about. The other thing has been about India's clean energy commitment and strategies towards that. Well, we have seen various statements from various ministerial panels yesterday suggesting that India perhaps could be taking lead in this. The way we have been working on gas and LNG and ethanol blending and hydrogen, and the conversation around nuclear was also much on the higher side. Much of electricity production, especially in the global markets, will now come from nuclear in 2025. India really seems to be climbing those stairs at this point in time. The other thing is about 20% ethanol blending. While we already have done 19% in the previous month itself, and expectations that you could be looking at a 20% in the month of Feb or March for that matter, the major question that arises is, what after 20% blending? Are we talking about E20 and E30 and E40 beyond that? So we understand and we hear from ministers here that yes, there is a framework, there is a committee that is committed to talk about 20% and beyond. And there also is conversations about whether on petrol pumps would you see different prices for petrol and diesel and ethanol going forward, because the taxation is different for these differential prices. So various conversations continuing here on day 2 as well at India Energy Week.
Okay, all right, Manisha, thank you very much for that. We do have to take a break on that note, come back on the other side. And Lata will be in conversation with well-known international trade expert, Professor Praveen Krishna, on what's at stake in the upcoming Modi-Trump meeting and the impact that tariffs can have on India.
Welcome to Indianomics. countries around the world have been on their edge after the series of threats by US President Donald Trump to impose tariffs on almost all countries. So far, of course, only one set of 10% tariffs have actually become applicable on Chinese imports into the US. However, President Trump has threatened reciprocal tariffs to be announced very soon. Many world leaders have been making a beeline to meet the president to strike bargains. India's Prime Minister Narendra Modi is also meeting President Trump this week in Washington. Will many of these tariffs actually be imposed? Are Indian imports more in danger of getting targeted since India's tariffs are seen as high and our imports are probably dispensable for the United States? What's the impact on inflation, rates, growth for the world in general? I have with me Professor Praveen Krishna, the well-known expert in international trade from the Johns Hopkins Institute at Baltimore. Professor Praveen Krishna, thank you very much indeed for your time. Very kind of you to sit up for us. I want to begin by asking, what's in your sense the expectation? Will tariffs actually go through, especially on India, simply because it might mean inflation to the United States as well?
No, these are excellent questions, and at this stage, it's very hard to actually say with any degree of confidence what will actually happen. As you've seen and you've already indicated through the campaign, and since President Trump got elected and since he's assumed office, we've seen a variety of different announcements, from uniform tariffs on all goods and all countries to very large tariffs on China, to even replacing all of U.S. income taxes with trade taxes, and now steel and aluminum tariffs and so on. So it's very hard to determine what part of this is simply some kind of a threat to maybe increase U.S. leverage in negotiations over trade, or something else that the Trump administration seeks. How much of this is really even intended as maybe some kind of a distraction, as some are suggesting, from the various other domestic policy issues that the administration is aggressively pursuing, and how serious they are about actually implementing these to achieve the kinds of things that they promised during the campaign. And in particular, as you know, President Trump campaigned on sort of "Make America Great Again" slogan, which really was in part about resurrecting manufacturing in the US, increasing manufacturing growth, increasing manufacturing employment, and so forth. And if that's a serious goal, or if that remains a serious goal, then I think we could say with some confidence that this administration sees tariffs as being central, kind of an important instrument to try and achieve that. Okay. On your question about inflation, it is undoubtedly going to be the case that any tariffs imposed by the US, especially the large tariffs that are not absorbed by the exporters, these will result in cost increases in intermediate inputs like steel and aluminum, like we're probably going to see very soon, and on final goods like automobiles and so on. And so there's an inflationary impact that we will see for sure. All of this is coming in a context in which inflation's already been a big problem in the US, and indeed a big problem around the world. And so it's, for that reason as well, it's a bit unclear how vigorously the administration will pursue a policy that is very likely to inflate, to create inflation in the domestic economy, here and elsewhere.
Yeah, you know, throughout the campaign, the cry was for a 60% import tariff on anything Chinese, but what actually has come to be 10%. So can we therefore assume that even with India, it may be more, bargaining to make India buy more military equipment from the United States, or something more specific, rather than force India to reduce all tariffs?
I think this is yet to be seen, what exactly the intentions are with respect to India. I think we'll know probably very soon, given that Prime Minister Modi is going to be in Washington, D.C. very quickly. But I could say one thing, that in addition to kind of military sales and so forth, there's a number of commercial interests in the U.S. that would like to sell more to India. This could be on the agricultural side. This could be, people from farmers from Seattle wanting to sell more apples to India, walnuts to India. There's an interest in selling more medical devices and so on and so forth. So there's a number of sectors in the U.S. that have a clear, direct commercial interest of motorcycles something that's already been discussed, and the Indians have already reduced tariffs on motorcycles for that reason. So I wouldn't say that this is exclusively sort of military sales. This could be part of a broader discussion that the U.S. would like to have with India.
Okay, so it's possible that I've just culled out the duties on agricultural products, and on most of the fresh fruit and vegetable, India has a 30% tariff, as well on some nuts like walnuts, as you say. Chances are, and even milk and milk products is about 30%. So do you think that there is a very good likelihood we may have to reduce tariffs on these?
That too is yet to be seen, because as my understanding is that the agricultural sector, the dairy sector, these are sensitive sectors for India.
Yes.
And so reducing tariffs in agriculture would be a greater challenge given India's own politics and India's own economics relative to maybe a tariff on motorcycles. And so I'm not sure that it would be that easy for India to do. I'm sure there's some appreciation on the American side about the political economy of India and the challenges that India faces in achieving a liberalization of this sort. So whatever happens will, of course, be, if this is the main issue and if this is the sort of thing that the U.S. Seeks to achieve, I think there's at least some understanding on both sides of the challenges in achieving sort of drastic reductions in let's say, in agriculture or in other goods. So I can't imagine that you would go from a 30% to a 0 or 100% to a 0 or something like that. But maybe some reductions in some sectors selectively. Maybe there's some phase-in that could be negotiated where the tariffs aren't reduced immediately, but phased in over a small period of time, 5 years, 2 years, whatever the case might be.
Okay. All right. So maybe 30 to 20 or something like that. You have spent a large part of your academic life looking at these trade patterns. What is your sense, like, say, 1 year or 2 years down the line? Are you going to see a general increase in tariffs everywhere because of reciprocity? Or do you think that the world will negotiate its way out? Your best guess.
Yeah. My sense is the world will negotiate its way out of this. That's certainly my hope. And I hope that is realized. The one thing I'll say, which I think your audiences might benefit from hearing from, is that, the last round of very significant tariffs that Donald Trump imposed, so this was, 2017, 2018, including very significant tariffs on China of average of maybe 20, 25, 30%. At that stage, there was a great worry that this would very substantially affect the global economy, that would very substantially affect international patterns of trade and so forth. And somewhat to everybody's surprise, it's turned out that it actually reoriented trade a little bit, but not a whole lot, right? So you would have noticed that despite all of this, all of the kind of the U.S.-China trade war in place and the very high tariffs imposed by the U.S. against China in place, that Chinese manufacturing exports actually grew by about 40% between 2018 and 2023. And just last year, this was widely reported in yes. January this year, the Chinese recorded $1 trillion trade surplus. So this is despite all of these tariffs being put in place, right? The point I'm making is that in the context of international trade, provided these tariffs are kind of within some reasonable range of 20, 15, 20, 30%, there are ways in which countries kind of find their way around it. The Chinese have sort of set up plants in Vietnam, they export goods to the US through Vietnam and so on and so forth. So there are ways in which trade finds its way around some of these regulations. Of course, if you had a much larger increase in tariffs, so we're talking about 50, 60, 70, 100%, something like that, which I do not expect and don't anticipate at all. But if you had tariff barriers of that sort, then things might get really difficult. But my personal sense is that we will find a way, that some of this may just be threats to achieve market access and openness in other countries from the American side, and then countries, just like India's already done in some sense,
okay.
Will look hard at their own tariff structures and see what they could liberalize and what they could offer up in exchange for access to the U.S. market.
Okay. In 2018-19, it was also noted by several brokerages and banks that overall global investment came down because of the uncertainty. Businessmen don't know where to invest and whether to invest. Is there a danger of global growth receding for the next couple of years?
For sure. I mean, we cannot have this type of chaos and uncertainty and arbitrariness and not expect to see some sort of impact on investment, some sort of impact on output. So for sure, I do worry that if this kind of continues for very long periods of time, kind of new announcements each day, new attacks against one country or the other, then it's going to create that atmosphere of uncertainty, replicating or maybe even worsening what you just mentioned happened earlier in the 2018-2019 period, and that's certainly something we do not want to see.
Okay, you know, the big positive that India sees from this entire tariff war is that we may be preferred over China. And actually, one of my colleagues' interview with the congressman, Republican who heads the India caucus, is also that we would like India to produce things where US is not competitive with China. You see that as a very big opportunity for India?
I think it's an opportunity. How big an opportunity it is or it turns out to be will really depend very significantly on India itself, meaning how good is our business environment, how easy do we make it for investors to redirect from China to India and so forth. So far, meaning following the 2018-2019 tariffs, I think that hope we had that hope in, following 2018-2019 tariffs, and I think that wasn't quite realized to the extent that maybe it could have been, right? So a very big part of this is dependent upon how private businesses see India as a productive place in which to invest, and taking the risks of China into account, finally take the decision that they want to move away from China towards India. I think a lot of that depends on what we do. I think one of the things I would add here is that the challenge of the moment is to find some common ground between India's own goals with respect to growth, with respect to manufacturing, with respect to exports, with respect to employment growth and so forth, in a sense that's represented by Prime Minister Modi's kind of Make in India program. How to find a common ground between that and the Trump administration's own campaign promise of MAGA, Make America Great Again, resurrecting the manufacturing sector. One possible avenue here and where we could benefit is to think creatively about ways in which American investment, American exports of capital, of intermediate inputs and so on, could plug into our own goals, meaning PLI, production linked incentives programs and so on. There could be things that we could be doing here creatively, meaning between the US and India, where American goals of manufacturing and